Okay, let's talk about a word you've probably heard thrown around, especially if you remember anything about the 2008 financial crisis: securitization. It sounds super complicated, right? Well, the goal today is to break it all down so you can see exactly how something like your car loan can make its way to the trading floors of Wall Street. Let's jump in.
So, what do your mortgage and a pizza have in common? I know, it sounds like the beginning of a really bad joke, but trust me, the answer to this question is the absolute key to understanding this whole process. It's a simple idea that unpacks one of the most powerful and, controversial inventions in modern finance.
All right, first things first. Why was securitization even created? What problem does it solve? To get it, just imagine your bank is a baker. A baker's job is to bake bread, right? And a bank's job is to make loans. But to keep baking, that baker needs a constant supply of flour. And for a bank, that flour is cash.
So here's the bank's big challenge. When it gives you a 30-year mortgage, its money, its flour, so to speak, is tied up for decades. Yeah, it gets paid back, but only bit by tiny bit, month after month. Now, if that bank wants to grow and offer new loans to more people, it can't just sit around and wait 30 years to get its capital back. It needs that cash now. So what's the fix? Well, instead of waiting, the bank bundles together thousands of those existing loans, mortgages, car loans, you name it, and sells the entire bundle in one go. Boom, they get a huge infusion of cash right away so they can get back to lending. For our baker, it's like selling all of their baked loaves to a big distributor, getting paid on the spot, and using that money to buy a mountain of new flour. This whole thing really works like a financial assembly line, and it has 4 main steps. First, the bank originates the loans. That's step 1. Step 2, it sells a big batch of them to a middleman. Step 3, that middleman bundles them all together into a brand new product called a security. And finally, step 4, it issues shares of that security for investors to buy. And just like that, your personal loan has been transformed into a product that's traded on the open market.
Now, that middleman we mentioned, it has a fancy name, a special purpose vehicle, or SPV. This isn't just any company. It's a separate legal entity created for this one specific job. And the most crucial part is that it's bankruptcy remote. What that means is it's basically a firewall. If the original bank that made the loans goes bust, the SPV and the investors who bought the securities are legally protected. It's a safety measure that gives investors the confidence to buy these things.
Okay, so the SPV is now holding this giant bundle of loans. But it doesn't just sell it as one huge, expensive block. Nope. This is where we get right back to our pizza. The SPV is going to slice this bundle up to appeal to all kinds of investors with different appetites for risk. These financial pizza slices are called tranches. And yeah, it's just the French word for slice. So each tranche gets its money from the same big pool of loan repayments. But, and this is key, they are not all created equal. Some are way, way safer than others. Think of this senior tranche as your classic plain cheese slice. It's the safest. Investors here are the very first to get paid from the mortgage payments that come in. Because it's so safe, it gets a high credit rating, but it also offers a lower return. Now, on the complete other end is the equity tranche. This is the extra spicy, everything on its slice. It's the riskiest. These investors get paid dead last, and if borrowers start defaulting, they are the first to lose money. So why on earth would anyone buy it? Well, to compensate for that huge risk, they're offered the highest potential returns.
So we get the how, the whole baking and slicing process. But let's just quickly nail down the why from the bank's point of view. It really all boils down to 2 primary motivations. First, as we said, is funding, getting cash quickly to make more loans. The second is something called regulatory capital relief. See, banks are required by law to hold a certain amount of cash in reserve in case their loans go bad. By selling off the risk to investors, they free up that legally required capital, which lets them, you guessed it, make even more new loans. And crucially, since the 2008 crisis, new regulations require banks to keep some skin in the game, at least 5% of the risk, to discourage them from just making a bunch of bad loans and passing the buck. Now, in theory, this is a pretty clever system for moving money around and spreading out risk, but in practice, well, it can go horribly, spectacularly wrong. And the most famous example of that, of course, was the 2008 global financial crisis. This brings us back to the most important question of all. The entire system is built on one simple assumption, that the original loans, the ingredients for our pizza, are actually good. But what happens when they're not? What happens when the pizza is made with rotten ingredients from the start? Well, in the years before 2008, the system was using totally rotten ingredients. Banks were issuing super risky subprime mortgages to borrowers who couldn't really afford them.
Then, these bad loans were bundled up and sliced into securities that were so complex, almost nobody really understood the risk they were buying. And because these toxic products had been sold all over the world, when people started defaulting, the losses didn't stay with one bank. They infected the entire global financial system because everyone had a piece, all while regulators weren't watching closely enough.
After the crisis, securitization was painted as the ultimate villain, and for pretty good reason. But it's important to see it for what it actually is, a financial tool. And just like any powerful tool, it can be used to build things up, or it can be used to cause a whole lot of destruction.
This quote really gets to the heart of the matter. Used responsibly, with good oversight, securitization can help credit flow through an economy, which is a good thing. But when it's used recklessly, without transparency, we've seen that it has the power to cause a global meltdown. The key is all in how it's used and how closely it's watched.
And that really leaves us with this final thought. Securitization is still a massive part of our financial system today, just with more rules in place. So the ongoing challenge for everyone, regulators, banks, investors, is to figure out how we harness the benefits of financial innovation like this while building guardrails strong enough to prevent another disaster. It's a question of making finance serve the real economy and not the other way around.